In this video, let's take a look at gold and its role in investment portfolio. Gold is almost up by 40% over the past year. For this reason, gold has been popping up in the news more often lately. And by the way, I have no interest in promoting or demoting gold. This video is the product of my pure curiosity. Beware that there are many promoters of gold on social media, and many of them are fear-mongering or stand to profit from you buying gold from their platforms. Many consider gold as a hedge against inflation or world-going bunkers. Famous investors like Ray Dalio advocate holding gold for the long term. His all-weather portfolio has a little under 10% allocation to gold. Here's Dalio himself on this.
You recommend that most portfolios should contain some gold. Why?
Yeah, of course.
Why?
The best way to structure a portfolio is to have the right kind of balance in your portfolio. Gold serves a purpose. It is, first of all, a diversifier against other assets. We have this risk on, risk off thing. We also have a monetary system. So it's a diversifying asset that is sensible.
Thanks to gold ETFs like GLD, getting exposure to gold has been very easy since 2005. Gold-focused ETFs let you get returns from gold without physically owning it. Before 2005, that was pretty much the only option, meaning you had to buy and hold your gold at home in safe or at a bank. And by the way, this is not exactly costless. The gold is subject to theft or fees, and fees alone can add up to about 0.5% each year of your total gold value. President Roosevelt outlawed private ownership of gold in 1933. After that, the US government confiscated gold from the US citizens to hold it at the Federal Reserve. That's how Fort Knox and many other storage facilities got their origin. Overall, the US had been de facto on the gold standard from the 1830s to about 1971. The gold standard set a fixed rate to exchange an ounce of gold for the US dollars. Before 1933, it was $20.67. Roosevelt devalued the dollar by resetting this rate to $35 per ounce of gold. The gold standard was a big constraining factor against excessive money printing. To print more US dollars, the US government had to have more gold in its vaults. And at the same time, many viewed the gold standard as too inflexible to accommodate economic cycles. It was too rigid, especially during economic recessions.
And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
On a historic day in 1971, President Nixon put an end to the gold standard in the US, and money printing has been unhinged since then. To give you a perspective, here's a graph showing a composite price index from the Federal Reserve. Increases on this chart equal inflation. We can see that inflation rates have become parabolic since the 1970s. Let's explore the dark side of going off the gold standard and inflation since the 1970s. Inflation is inextricably linked to fiscal and, most importantly, monetary policy decisions. A giant in economics like Milton Friedman once said that inflation is always a monetary phenomenon.
Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later.
Let's understand why sovereign nations would welcome inflation. And the main culprit is the government debt levels that are rising pretty much anywhere you look at. At some point, debt and interest payments become too excessive to handle. And for a sovereign, there are several ways to deal with excessive debt burdens, depending on the type of debt. And one of the most obvious ones is to pay off debt. But that requires some trade-offs, like maybe cutting off spending somewhere or just have spare funds, or sometimes raising taxes, which is not exactly popular. Another way is to default, but sovereign defaults are very nasty and messy. True, they can lead to wiping out debt clean, but they can also lead to lawsuits, asset confiscations, and also exclusion from debt markets. And the latter one is the most unpleasant one, since the defaulting nation can no longer borrow from international investors. And these exclusions can last anywhere from a year up to several years. Argentina is a known serial defaulter. It defaulted 9 times, and since 2000 it included 3 times of defaults. And in the most recent one, which was in 2020, Argentina owed over $300 billion in federal debt. So we can see that investors are willing to forget past sins and are willing to lend again. The third and less devastating way to reduce that burden is through inflation. And this method only works for sovereign debt denominated in local domestic currency. And unfortunately for Argentina, this method was off limits for them, since most of their federal debt was denominated in foreign currencies. But how does it work? Well, imagine a small baker. He borrows $100 to buy some equipment. Let's say that $100 is worth 100 loaves of bread, or $1 per loaf. If there is inflation of, let's say, 100%, 100 loaves of bread are worth $200, or $2 per bread now. So $100 of that can buy only 50 loaves, not 100 loaves as before. In other words, the real value of that went down by 50%. The baker doesn't have to bake and sell 100 loaves to return $100 to his bank. He only needs 50 loaves. Inflation favors borrowers and hurts lenders. Many sovereign nations with lots of local currency debt actually welcome inflation as a relief. And this is where the argument in favor of holding gold as an inflation hedge comes in here. Many argue that gold price should offset any inflation happening long term. In their paper, There is Still Golden Dilemma, Erb and Harvey explored this idea. This plot shows CPI inflation versus price of gold from 1975. If gold was a perfect inflation hedge, the graph would look like this red dotted line. In other words, the price of gold would offset inflation 1 for 1. But historically, this has not been the case. Sometimes the gold price outpaces inflation. Sometimes gold undershoot inflation, meaning it was not such a good inflation hedge. Still, we see that the price of gold increased and kept up with inflation over the long term. There's another important lesson from this graph, and that is that there are many other factors that affect the price of gold. The thing is that gold doesn't pay dividends, so all of its investment returns must come from price appreciation. And hence the dynamics between supply and demand determine the direction of gold. If we look at the demand side, here's the breakdown of gold stock back in 2023. There was roughly 212 tons of gold in stock. 45% of that sits in jewelry, while bars and coins account for 21%. Central banks' gold holdings were in third place, accounting for 17%. Gold has industrial use in computers, communications, and jet engines and such. One note on this data that it's not exactly accurate except for ETFs. Even though the figures are public for, let's say, central banks, there's no way of knowing that these numbers are true. As far as supply goes, there are many gold mining companies around the world. The largest gold-producing countries in 2024 were China, Russia, and Australia. In 2024, around 3,300 tons of gold were produced, so gold supply gets inflated by about 1 to 2% each year. By some estimates, humanity has mined over 3/4 of all gold reserves in Earth. But it's an estimate, so who knows if it's accurate. Lately, there has been a lot of buying coming from central banks. Poland, Azerbaijan, and China were among the top buying central banks this year. Again, we should take these numbers with a grain of salt, especially from China. Gold reserves in China look like a step function. I have my doubts if this has been the case. De-dollarization as a topic has been trending too. So far, there are little details, but a lot of talk. At the 2023 BRICS summit, Chinese President Xi Jinping proposed the reform of the international financial and monetary system. Who knows what will come out of it? China looms large in the BRICS Union, and nothing came out of it so far. And maybe it's a timing issue to work out the details, or maybe it's a dilemma for smaller nations in the BRICS Union. They don't know and are concerned how the new regime will look like and who will stand to gain or lose most from it. Gold could be part of the solution to de-dollarize, but I'm not sure that nations are seriously deliberating on the gold standard. The thing is that gold standard imposes inconvenient constraints on monetary policies that not everyone would welcome. On top of it, to use gold in this new de-dollarized regime, BRICS nations would need way more gold than what they have today. And it will require a lot of buying, which will not only take years, but also will push the price of gold way too far, making this de-dollarized regime very expensive. But make no mistakes, central banks' buying of gold, especially lately, does support the price of gold. So far, the US dollar accounts for roughly 58% of all official foreign exchange reserves. The de-dollarization is a whole another and a very complicated topic to explore on its own. The biggest question is, what's the alternative? You must have another currency with a scale and depth which is comparable to US financial markets. And many don't see a viable alternative, at least for now. But what if there's a material decline in trust in the US as a safe and liquid place for global financial assets? Then the US dollar may lose its reserve currency status. We can transition to multi-currency reserve world. And in that scenario, gold can become even more valuable. Let's come back to gold again. As an investment, gold is not exactly riskless. According to Morningstar, its standard deviation was about 20%, and compare this to stocks' standard deviation, which is about 15% over many years. If we look at long-term returns since about 1971, gold has not done better than large-cap stocks. Even a traditional 60-40 balanced portfolio did better according to Morningstar. But of course, performance depends on the time horizon in question. For instance, since 2004 or 2005, gold ETFs performed almost on par with the S&P 500. That's impressive. When it comes to inflation hedge, Morningstar also looked at this exact question. They compiled a commodity price index with many inputs. Among them are crude oil, natural gas, agricultural commodities, as well as precious metals. Here's their conclusion. During high inflation episodes, the commodity index did consistently better than gold. The reason for this is not difficult to understand. Commodities like oil, natural gas are themselves part of the price index like CPI. They also go as inputs to manufacture other goods. Thus, their use in economies is far greater than that of gold. Conversely, the gold price reflects many other factors, as we saw. For example, the gold went nowhere in the late 1980s, and many blame bonds for this development since they came with a very attractive high yields. Another reason to hold gold is when all hell breaks loose. I personally saw this when I was growing up in the former Soviet Union Republic. At some point, USSR countries went off the ruble and introduced their currencies. At that time, the entire generation of people got their savings wiped out overnight. If you held most of your net worth in gold, jewelry, or other non-monetary assets back then, you were already ahead of everyone. When things were really bad, some people traded their jewelry for money and then later bought food almost immediately or other necessities. Generally, it was not a good idea to hold on to paper currency for too long. Raging hyperinflation would make it worthless pretty fast. Also, theft was on the rise back then. A few of our neighbors' apartments got robbed and cleaned of all their valuables. But either way, I can see where the argument in favor of gold is coming from when the world is going bonkers. If that's your reason to hold gold, then ETFs are not exactly suitable for this reason. It is better to hold and own gold on your own, either in a safe at your home or in a bank. But you must also make sure that not only no one can steal it, but also your government cannot confiscate it, which it can. While some people buy ammunition and dig holes in the ground to hide their gold, Wealthy individuals actually deposit their gold in other countries, and Switzerland is one such option. But for an average person, this is not exactly practical and maybe very expensive. On another note, many people wonder where the price of gold is going from here, and Erb and Harvey explored this question in their paper back in March of 2024. They looked at real prices for gold since 1975. Their conclusion was that the real gold of price back in March of 2024 was too high by historic norm, and this led them to conclude that the returns from holding on to gold for the next 10 years are likely to be lower. But what do you make of that? The gold price is up by 46% since they published their paper. Warren Buffett openly dislikes investing in gold. He shared some of his thoughts in the letter to Berkshire shareholders back in 2011. His basic premise is that gold produces nothing. Its use is mostly decorative or industrial. For the gold price to grow, the pool of buyers must expand, or the marginal buyer must be willing to pay a higher price. Buffett says as bandwagon investors join any party, they create their own truth for a while. We saw before that stocks can do better than gold over a very long term. If we look at traditional Boglehead's 3-fund portfolio, it has no place for gold, and I can understand why. But there's of course another view, and there gold is a valuable tool to hedge against inflation, as well as world-going bonkers. There are pros and cons to either view. I hope that this video shed some light on the questions that you may have had and made it a little bit more clear for you to understand what's going on. If you enjoyed this video and learned something new today, give it a like. It means a lot to me and the YouTube algorithm. Also, subscribe to my channel. I post weekly content on investing and other economic topics. All the best!